Common tax savings for business owners, part 4, employing the spouse. Now, where the spouse has no other income, this is an obvious one, because you can use their £12,570 personal allowance. So you can pay them £12,570 through your limited company. They won't pay any income tax, they won't pay any employees' national insurance. And because the both of you are employed, you will get the employment allowance as well. So there won't be any employer's national insurance. So there'll be literally no tax or national insurance to pay out on that. And that expense would be a cost to the limited company. So it would reduce the limited company's profits, and you'd save corporation tax at 20%. So your 20% tax to the good. That's an obvious one. Where it's often overlooked though, is where the spouse already has a job, so they've already got an income. So you'll be thinking, well, they've already used their £12,570 personal allowance. That's correct, but the employee national insurance sort of threshold starts again for each employment. So on your spouse's employment from the limited company, yes, they would incur tax at 20%, assuming they don't go into higher rate tax. So they would pay tax at 20%. However, there would be no employees' national insurance. There'd be no employer's national insurance, assuming you've still got the employment allowance to utilise. And that would be a cost to the limited company. So although the spouse would pay tax at 20%, the business would get a corporation tax deduction of 20%, which means essentially you're getting that money out of the company without paying any tax. Now, this is going to be much better than if you're paying dividend tax at 10.75% on that amount. So that is something that's worth looking at where it fits.